Ladies and gentlemen, Tevis has sold out of SoFi stock. No, I'm kidding. He sold about 10% of his portfolio, and a lot of that was in other positions as well outside of SoFi. And he also did that to, potentially buy out options for a private company that is going to yield him results that SoFi literally could never do. So it was a smart move for him, and he's a great investor. That being said, it is a great time to discuss when should people start selling SoFi. I mean, it's up into a position right now where every single time that I've ever purchased SoFi, all the way back in like early, or December of 2021, January of 2022, has always been green since then. So do I take a little bit of money off the table and enjoy the profits? Well, currently I am not. Okay. The way that I invest is very simple. I try to pick winners, hold them for the long term, and then look at them based on their valuation for simple metrics like PEG ratios, for example, or price to earnings growth ratios. Now, I'm a big fan of Peter Lynch, and he's always said that that was his favorite metric. And the reason why he would do that is because he said that it also prices in not only the current price of the stock, but also the future growth potential that it has. And now, whenever people end up taking a look at something like SoFi and they just look at a PE ratio, they can see very high prices, like 130 times price to earnings ratio, and seem like it is being very overvalued. Now, I held through Nubank whenever they were not a profitable company to whenever they were actually having a price to earnings ratio of around 550 times. Today, forward price to earnings ratio is just around 20 or so times, 25 times, something around there. The price to earnings ratios can come down. This is why we like to price in future growth. Now, there's two ways to look at that, and I want to get into it, as well as when to sell and why I am not. So let's just start with where SoFi is seeing their PEG ratio right now. So there's two ways that I'm going to look at this. One, which is management expectations of earnings, and then two, what Wall Street is expecting for earnings. So if we actually look at Wall Street's expectations for earnings on SoFi, what you're going to see is that they assume in 2024 that there will be 13 cents of EPS. I think that that is a smart valuation. It might even come in at 14 cents if we're lucky. But then 2025, 28 cents, nothing too crazy. 2026, 47 cents. 27 is 64 cents, and 28 is 82 cents. In my opinion, 2026 will do more than 82 cents, but management even is suspecting that they will come in somewhere around 55 to 80 cents. Okay. And then about 25% compounded annual growth rate thereafter for probably the next 2 years or so. So if you take that into account versus what Wall Street is accounting for, Wall Street is placing the PEG ratio on SoFi somewhere around 1.3 times as of today. So a little bit overvalued, probably 30% overvalued, pricing in their future growth. But whenever you account for management expectations, what you're really getting is a PEG ratio between 0.85 to 0.9. Okay, that means it's actually undervalued from where we could continue to grow to, which is a 1 times price to earnings growth ratio. One of the things that I really want to keep this on is in 2026, there's a couple things that are happening. There are performance-based stock units that Anthony Noto can actually end up receiving if the stock can hold up a certain valuation. Now, those prices for June of 2026 are held at $25 a share, $35 a share, and $45 a share. Why would they place them that high if they didn't think that they could grow into it? And yet SoFi has been able to continuously expand and beat their expectations every single quarter since being a public company. We're going into a macro that is potentially the best in 7 years, according to Anthony Noto, which means that they could expand on revenue sources that have done them the best in their history, like lending, for example. And yet, this is not accounting for other things that they could potentially grow into that we don't even potentially even know, like the loan servicing business, business banking, etc. So I'm completely optimistic. But I can understand for a lot of new investors why it feels so hard to hold on to these paper gains, because you definitely do not want it to fall and lose out on the opportunity of selling higher. So how do you balance the risk between holding on to a stock that has ran, but also not sell it to not, benefit on it continuously growing going forward? What I can tell you guys is this. Every single large opportunity loss that I've ever had in my stock investing journey has always been from selling things too early. It's never been from buying more. The truth is retail investors like you and I will still be able to get our hands on unbelievably great companies. I'm sure a lot of you guys have held similar stocks in Amazon or Apple or Google, Tesla, Nvidia, and yet had sold it too soon before they had ran too far. This is why I continuously try to shine light on a very easy saying: let your winners ride. SoFi is multiplying users at very fast rates, and that is not slowing down. In fact, it's actually accelerating. Revenue per user is continuing to climb, and their amount of defaults on their loans, as we look at the seasoning of those loans, are getting better and better. The truth is that myself nor Wall Street knows what SoFi is going to dip their hands into next, right? I've held on to Nvidia for an extremely long period of time, and for the longest time of me holding that, I had no idea what they were going to do with artificial intelligence. The benefit that I had was that I knew that I liked the company and their operations, and that if there was something that was going to arise, I knew that they would take advantage of that. So this brings me to this. When should we sell SoFi? Well, one, whenever the valuation gets too high. I don't think we're there yet. Two, whenever there's something in the market that you like even more than SoFi. I'm currently not seeing that. And three, and a lot of people here could be a part of this, if the percentage of your portfolio in this one individual stock is getting too high, maybe it's time to trim and look for diversification. That one, very seriously, could be a great idea for some of you. But overall, I still think that we're undervalued. And I also think that stocks can even get to areas where they become expensive and even look like they're slightly overvalued as people get optimistic. But it doesn't even seem like we're doing that. It just seems like people are trying to rightly value SoFi for all of the areas that they've been in aside from banking, which is what we've been praying and hoping for the longest period of time. And lastly, to Tevis, sorry, buddy, had to use you in the thumbnail, but do appreciate you being a good sport. You're going to get roasted on the SoFi Weekly. Everyone knows it, but you deserve it because you sold out of one of the greatest growth stories in financial services. Ladies and gentlemen, thank you all so much for watching. Really do appreciate your time. But bye for now.